So I think we'll have a very strong rally into April, something like that, maybe March, April, and then we should see a flattening thing, and then we should start to see the decline, and then the economy will simply just we'll just see the deterioration there, and we'll start to see some of the bad things coming out that the leading indicators have already indicated for us and said, okay, things are not good. So I think when we stand by October, November, I think things are very much different, and I actually think that will be the point already where we see the Fed, will change course, and we will see that they'll start to stimulate again. So I think by the end of 24, the Fed will be very much engaged again in stimulating the economy, because the deflationary bust. And let me just say this: a year ago, people were still a little hesitant and saying, "Well, yeah, we did see the top in inflation in June, but it's just a new low now, and then we'll go back up again." But we didn't see that. We actually saw exactly what I was forecasting, that inflation was coming down because it was due to supply and demand. And now when it's coming down, and the Fed has been so hawkish, and we still have this, now also with the recession coming in, I can tell you the deflationary bust we're going to see here will be something we haven't seen in many years, and it'll be bigger also, as I see it, than what we saw during the financial crisis. So I think it will be until we will be sort of safe until April, and then I think the waters will not be so safe more if you're long risk assets.
Welcome to WTFinance. I am its founder and your host, Anthony Fatsis. 2023 was an interesting year for the economy and markets, defying many expectations with a strong rally after a turbulent 2022. Analysts expected continuing weakness and a continuation of the 2022 bear market, with rising interest rates and fears of a recession dampening investor sentiment. It was estimated that growth would decrease, there'd be low single-digit gains in most indices, and the technology stocks will continue to struggle. How wrong everyone was, including myself. There was an unexpected surge in United States major indices, with S&P soaring over 20%, Nasdaq Composite over 40%, and Bitcoin over 150%. 2023 was a year of risk on, as we seem to continue to see every single year these assets are continuing to increase. It was a year of unexpected optimism and resilience for the stock market. I'm pleased to welcome back Henrik Zeberg to the WTFinance podcast. He's a macro economist and the founder and publisher of the Zeberg Report. Henrik was one of our past guests who talked about the economic strength and his positive expectations in August, when it looked like markets could roll over. This has proven to be correct so far, with strength in markets continuing from September to the end of the year, despite not hitting Henrik's target of 6,100 for the S&P. Regardless of the strong performance in Q4 23, Henrik agrees with current sentiment that things for the risk on assets will continue to improve quickly before peaking after Q1 this year, followed by a potential crash. So Henrik, thank you so much for coming back on the podcast today.
Thank you very much for having me on, Anthony.
No, Roman, I'm looking forward to our conversation. First interview of the year, and it's been a while since we last spoke, but I think you got things quite well. It was sort of, we spoke during the time where there was lots of pressure in the markets, lots of concern from people. People were thinking, finally the recession is here. The market's going to expect that. But since then, things have been going quite well, especially the last few months of 2023. And I think that's something that you predicted as well. So from your perspective, are you thinking that's going to continue throughout this year? Or what are your thoughts of what we're going to see throughout 2024?
Well, I think 2024 will be kind of a whipsaw year. I mean, the developments we have seen for the last couple of months here, or the last quarter, I would say we should see that continue into 2024. I think that the stock market will be, now we have a small pullback for the last couple of days here, but that's really nothing in my book. But the stock market, crypto market, so on should keep moving up higher. Bitcoin should reach 100,000, 150,000, maybe even, and we should also see S&P reaching 6,100, which has been my target since I think a year and a half ago. All these things are still playing out. So to me, there's no changes. This is the blow off top. This is the business cycle that is coming to an end. It was not at an end a year ago, which was very, very clear to me. And now we are getting closer to that, and that's why I expect it'll be something of a whipsaw year, because when we get to the middle of this year, I think we will see a change from this very bullish environment to actually the outright opposite. And I think we're going to see a crash into the last part of the year.
Okay, that's quite interesting. So I know we talked about the business cycle previously, but it's something that I find quite interesting when you talk about it. So can you maybe explain to us how you see a business cycle, or how you define it?
Well, it's not something I defined really. I mean, something that has been defined by the conference board. That's something that can be looked up, and you can go get the data. If you have to pay a little for it, but you can actually get the data also there for the leading, the lagging, the coincident indicators, which is really a way of looking in the economy just by, there is not just one business cycle, but there is a cycle where there are things that are pointing to what is come to come. There are the cycle which shows you where is the economy right now. And then there is also the cycle which gives us which direction do we see rates and the likes. And these I follow, and I just not just follow them. I constructed a model together with Swissblock, which actually, when you backtrack it on a quarterly basis for the last 100 years, every time you had a recession signal coming out from that, it actually we did get a recession, and it's not having it hasn't predicted any too many recessions or anything like that. It's been spot on in terms of nailing it when it comes to recession, and we do have a recession signal in now, which means which was opposite from what we had last year. There was no signal there. So now we are in a situation where we are waiting the economy actually to start to deteriorate. And one of the things that we need to see is the rate starting to come down really strongly, and that will be the second factor in my book, or third factor, I would say maybe. And then there is the deterioration of the stock market. But with the current strength in the labor market, I think we can get into maybe April, May, June, before we see the top in the stock market first, and then a couple of months later on, we will see the recession begin.
Okay, that makes sense. So you mentioned there, and I think that's a really good point that you mentioned, that there's all these different trends occurring, all these different cycles occurring, and sometimes people think, it's one big beast, everything's happening at the same, all in correlation, but no, there's all these different cycles occurring at the same time. And it sounds like what you're doing is trying to measure each of those cycles to the point where once they all overlay, saying, similar trends or similar thinking, that's when, as you said, the recession should come. Is that sort of how it works?
Not entirely, actually, because there
Okay.
are, if you look into the conference board, they have leading indicators, and the reason they call it leading indicators is because they lead the economy, and the economy being the GDP is like the labor market and so on and so forth. But what leads the economy, that can be found by what, if you look into the conference board there. Some of these are housing permits and things, initial claims and other things. But what we see in this cycle here, this time around, what we also saw before the financial crisis, is actually you have deterioration in the housing market. And that comes because of a normal spike in inflation. This time it's just been exacerbated by the imbalance in the supply and demand due to the COVID stimulus that came out, which was crazy, and that created an inflation spike. That inflation spike spilled over into rates, which is also normal. The rates are now spilling into the consumption of consumers, so consumers start to consume less, and that will then spill into the companies, how the employment plans. So how many people do they want to keep employed, and how with the current capacity does that fit what they need to meet? And this is the process that you actually have, and that's why when you look at the leading indicators, you actually know what is going to come to the coincident indicator latest stage. Coincident indicator being GDP, employment, and so on. And for now, the leading indicators have been saying to us, telling us that a recession is coming, and the process has begun. And now it's about when we actually start to see that in the labor market, and that we haven't seen yet. I mean, the initial claims are at historically low levels. NFP numbers have been, rather strong. Job openings are still strong, also, and so we are not in a situation where the economy is rolling over at this point here, and that's was very clear a year ago. Now it's, as I said, it's the deterioration is there, but it's not something that happens overnight. And I think people are too impatient when it comes to say, okay, now we see something coming out in terms of data, hence we are in a recession right now. That's not how the economy works. It's a super tanker, and we need to consider it as a super tanker. And that's how the very thorough analysis of business cycle and understanding of that actually can help in doing wise investments on the stock market and elsewhere.
Yeah, it's a good point. It does seem that, so if you look at those leading indicators, a lot of them were maybe looking at recession quite a lot earlier than what we've currently experienced. So it does seem that there's been quite a big gap between those leading indicators to, I guess, the more concrete, employment stats that you're talking about there. Is there a chance that maybe due to the nature of what's happening in the US and I guess other countries with employment challenges, we're looking what a lot of these countries are going to anti-immigration. Is there a chance that maybe there's going to become a disconnect between these indicators, or do you think it's just we have to be more patient, it's going to come?
I think it's interesting every time we see something like this where there is a lack, which is actually quite normal. If we go back in time, we saw before the financial crisis, you actually had, I think it was 20 some months of negative indicators, negative leading indicators from the conference board before we actually saw the recession. And that just shows something of the magnitude of the crisis that is coming. So what people think is that, oh, we didn't see it immediately, hence, Titanic will stay afloat. Well, no, the Titanic has hit the iceberg. There's no chance, in my book, the way I look at things, that we will not have a recession. And so Titanic is going to sink. But for now, yes, the music can play on, and it may even feel a little, warm and fuzzy, because the stock market may rise a little, faster this next month here, and also crypto market and so on. And people will jump into the other boat. And remember, when I was here a year ago, I was exactly saying the exact opposite, and the sentiment was the exact opposite. People were saying, "Hey, Henrik, maybe this time you're wrong, because you'll see that the recession is here, and maybe you don't interpret your model correctly." That's not how I see it. The model and the strength of actually understanding the business cycle, the leading indicators telling us that that's the iceberg. We hit that. Now, yes, Titanic is afloat, but it's going to sink. And also with the latest development in yields, market yields that we have seen, I'm not at least in doubt that anyway in doubt, I should say, that we will see a recession. There is a recession when we talk again next year at this time. There's no doubt about that.
Okay, that makes sense. So what are you going to be watching out for? So you're saying the next, I guess, 6 to 9 months, you think things are going to be looking quite good. Market's going to explode up. And then from there, you're saying the end of the year that you think that's when we could see these recessionary indicators further permeating throughout the rest of the economy, and then potentially the market's catching on to it. Is that sort of what you're saying?
I think it's more like that we're going to see the recession starting around mid this year. So June this year would be my guess at this point here, that we could see the recession set in. And from that moment, actually a couple of months before that, I would think that the stock market top would be in, and the crypto market. So I think we'll have a very strong rally into April, something like that, maybe March, April. And then we should see a flattening thing, and then we should start to see the decline. And then the economy will simply just we'll just see the deterioration there, and we'll start to see some of the bad things coming out that the leading indicators have already indicated for us and said, okay, things are not good. So I think when we stand by October, November, I think things are very much different, and I actually think that will be the point already where we see the Fed will change course, and we will see that they'll start to stimulate again. So I think by the end of 24. The Fed will be very much engaged again in stimulating the economy, because the deflationary bust. And let me just say this: a year ago, people were still a little hesitant and saying, "Well, yeah, we did see the top in inflation in June, but it's just a new low now, and then we'll go back up again." But we didn't see that. We actually saw exactly what I was forecasting, that inflation was coming down because it was due to supply and demand. And now when it's coming down, and the Fed has been so hawkish, and we still have this, now also with the recession coming in, I can tell you the deflationary bust we're going to see here will be something we haven't seen in many years, and it'll be bigger also, as I see it, than what we saw during the financial crisis. So I think it will be until we will be sort of safe until April, and then I think the waters will not be so safe more if you're long risk assets.
Okay. Do you think there's a risk maybe that there could be another supply chain shock? So we've seen recently there's a impacts on sort of global trade, shipping with the sort of conflict in the Red Sea and the Houthi rebels, and a lot of the shipping costs have gone up close to 200%. Do you think that could be another supply shock that's coming through, which could be similar to COVID, which actually increases inflation, in the short term, or do you not think that's
No,
going to have a big impact?
I don't think it has a big impact. I mean, this is still, yes, it will bring rates up a little on some of the routes around the world, and that's what it is, and that's understandable. But I think that's also a situation that will be taken care of. What we looked into when it was COVID, it was a global shutdown. People couldn't go to work and all over Europe and US and Asia and so on, and that means that nothing actually could be produced. And at the same time, you then had this massive stimulus coming in on the demand side, which means that then you had a total, imbalance between the two things. So you have to think that you did like this that time around. This time around, you may have, the one of them is maybe decreased a bit, but this is something that will be mitigated. So this is a small thing. It's a non-event in the bigger picture. So no, and also with the current push lower in demands around the world and companies that build up capacities after the corona crisis. Everybody was doing well just in 21 and into early 22, and then it was like, okay, now inflation starts to pick up, and that's why we did see the slowdown. But companies were not reducing their capacities again that they built up into after the just after the financial the corona crisis. And that means that the extra employment that they took in, the extra, whatever storehouses, warehouses, or whatever they did, that will have to, come, out of the system, so to speak. Again, the capacity will need to be reduced, and that is what will drive the deflationary bust. So I cannot see any way out of this, and I know that I'm going to talk to Raoul Pals on this on what is it, next week sometime on Rand Neuner's show, and I think it's and I think he's also going to say something along the lines of AI will change things, and I just don't understand why people do not see that what we have right now here is something that will happen to us within the next 6 months and 12 months, whereas what we're talking about in terms of AI and other things that should save us is something that will be implemented over the next 10 years. So the timeline or the horizons of this are just not comparable. So the business cycle will work, and they will bring the economy into a recession, and the Fed will be a little slower this time in starting actually to stimulate. And I think we will gonna see some black swans falling out of this, and we're gonna have financial crisis 2.0 this time around as well.
Okay. Yeah, no, I agree with what you're saying in terms of a lot of people there's these long-term trends, but it's understanding that, as you said, they're in the future. There's going to be these shorter-term business cycles that are going to have an impact on these stocks. Like we saw in 2000, and then Amazon and the other massive companies blew up after that. But if we talk about, so it is an election year in the US, and do you think they have gotten to the point where they're at maximum stimulus that they can put into the economy, so maximum fiscal stimulus, maximum deficit, or do you see there's the potential they could actually increase that even further going into the election, concerned because Trump could be elected?
I'm not I mean, the business cycle, when we look at the economy and the size of the economy, and when it starts to take a tumble, I don't think you will find that the central banks and the administrations around the world will be as fast as it requires to get in and actually make sure that it doesn't tumble. And I don't think they can actually. That's another thing, because it's so much bigger. Also, because when the stimulus, whatever stimulus they can come up with, needs to find its way into the into the economy, into the consumers. It's all about the consumers. We have to remember the GDP in US is around 70% of GDP is consumption in the US, and that means that if the consumers right now are taking a toll on or getting hurt by the high market yields rates that we have, which they are. I mean, they struggle just to pay the mortgage bills. Well, then it's again, if they then are given more money in the hand, would then they start spending that immediately? We have to think like this, because if they got some money in the hand, would they then save it up and to safeguard themselves a little, for if there are harder times ahead? So stimulus coming out is not necessarily something that works. This is what people do not understand. It needs to be spent and spent again and spent again before you get the multiplication effect from it. And so whether they are on maximum stimulus, there will always be another stimulus package if required and if needed. But I don't think you will see anybody in Congress that would actually support any kind of stimulus at this point here. And that's why I think, yes, it will eventually get there. We will see the stimulus, but that's when things are already too late. And then we have to remember it's a super tanker. It's not a speedboat. You cannot turn it on a dime. So when they start to inject that stimulus, depending on how fast people, the consumers, are starting to actually, adapt to this or start taking this in or spending the money and doing whatever is required, it takes a while. So and cutting rates will not just make it either. I mean, it needs to take a deep cut before we start to see that, and that will take time as well, because we know the Fed will do it gradually as they always do also. So as I see it, the iceberg has been hit by the market yields, which are hurting the consumers. And yes, stimulus will come out. Yes, Fed will come out and try to save this, but they will not be able to avoid the initial bust that we see. What they will avoid is where the bust continues as a negative spiral and just keeping going lower and lower. That's what they did also in 2008. But this is about front running the whole thing and making sure we never get another recession. That's not going to happen. And I think actually this time around, their action will maybe be the thing that can trigger the next type of crisis we could see, which I think will be a stagflationary crisis, which I think after what we see first starting this year into maybe 25, then the year after we could see a stagflationary crisis where it will be a totally different kind of ball game in terms of what will be required to actually stem up the crisis or bring the economy back on its feet. So I think it'll be very difficult.
That makes sense. I guess if you look at the rate hikes, it's taken close to 2 years for them to actually go throughout the economy. So, it's going to be the same for the cuts. Maybe not as long, but it is going to take time to permeate. So if we look at, you mentioned next 4 months are going to be great. So are you thinking the risk on assets, the highest beta, those sort of riskiest, the cryptos, the AI stocks, everything like that, they're going to be the highest beneficiaries, I guess, in the short term at least?
Yes, I do. I absolutely do that. Thinks that's what we're going to happen. This is the blow off top. We're not done with the blow off top that I called last year. We are we halfway? Yeah, we may be halfway or something like that for certain. I mean, for the S&P and for the Nasdaq. I mean, this is going to be quite extraordinary what we see the next coming month here. I think when we see this shaky start of the year here, we've had the first week, but I think the last part of January is going to be very bullish and strong in equities and crypto as well, and Bitcoin. So I think it's going to be a very, very strong move up, and nothing that we've seen earlier on. And the reason for that is because that's based on the technical analysis that I do, where I have certain Fibonacci lines and extensions that I'm looking to, and it just seems like we're going to stretch up for some of the extreme highs here, and that's why I have the 6,100 for the S&P 500 and 27,000 for Nasdaq. So I think things can go really, really quick into the next coming months here, and this will also be why a lot of people will be convinced that what I'm sitting here and saying right now is wrong. So if we talk in 4 months time, and I'm actually standing there pointing at the top, and then people say, no, you're wrong, because you see the stock market is front running the economy and it's running up like this, so you must be wrong. And this is where I will look to the business cycle and understand that we already now have seen the recession signals flashing. We've seen the rates, the market yields coming down, and now we need the stock market to just blow off the last air into the extremes, and then we'll see the top. So I'm long now. Let me just get this very clear. I'm very long, much long the small caps. I got crypto, I got Bitcoin miners, and so on, and I've been that for a long time. So it's been a great year. But I'm expecting it to I'm expecting that to change, radically by mid of this year.
And will you get out of those trades when the economic data comes through? Or will it be a technical? What will sort of influence you to get out?
This is based on, I got a multi-factor model which will point to a lot of things. So there will be a rate signal, there will be an equity signal by itself, there will be a crypto signal, there will be a economic signals. I got 17 recession signals, which will tell me when we are in a recession. So I think I'll get it either on the month or the month after. So there will be so many things. There will be Fibonacci levels that needs to be reached and so on. And then, so it'll be a gauging of all of these, and then figure out where do we stand. But again, if that all plays out rather, at the same time hitting, certain levels and getting certain signals, well, then that would be the perfect world. And that is what I'm hoping for to see. Actually, that's what I saw the last time. So I think we can, I think I can do that again. So let's see when we stand in 6 months down the road, if I'm not completely have a completely different portfolio than I hold right now.
Yeah, it'll be interesting to see. So do you see this recession? You sort of talked about it like it could be quite a big one, 2008 2.0. Is that what you're currently seeing? You don't think it's going to be, lots of people talk about a mild recession, that, certain economic growth will sort of push us through, but you think it's going to be quite big?
There's no indication why this should be a milder recession. Absolutely not. The worst recessions we see is when the housing market takes the strongest dip. That's historically, if you go back in time, that's always been the ones where we see we get the strongest hit in the economy. And if we look to all the data we got in terms of the housing market, which again is something that front runs the S&P and also the economy, well, then we've seen the housing affordability. We've seen NAHB, some of the indices that I'm following in terms of the housing market. They have just plummeted. And that tells me that this is going to be really bad. The only thing that is keeping Titanic afloat right now, that is the labor market. And the reason that is because companies have been hiring in people, building capacity. They were so good at doing their jobs or doing their businesses in 21 after all the stimulus came out, and they hired in people, they built the capacity, and they don't want to let it go just immediately. So they have been hanging on to it a little extra longer here and thinking, well, let's see if that demand doesn't come back. And when it doesn't, then they'll start to let people go. So it's hanging by the thread of the labor market, and some will say, yeah, but maybe that can stay strong. No, because I think the businesses will see that the demand is nowhere near where it was when they build up the capacity levels that they have ready right now. So I think it will change, and it will change rather quick. And again, we have to understand that when the spiral starts to get going, then when you see the layoffs and demand crashes, and then more layoffs, then it can go really quick. So no, I don't expect us to be able to navigate ourselves out of this one, and it will be big because it's based in the housing market, and I think also we can see this time around that it's going to be on a national state level. I think we could see problems in Europe. I foresee a very big crisis in Europe. It seems like Germany and UK haven't even though we've been in a technical upturn since we had the Corona crisis. Well, we never saw actually the housing market in Germany and UK actually getting much better, which is rather extraordinary. So that means that I think this time the next downturn will be very, very big. And And also, if we look at the whole speculation there is around crypto, and if I'm right, I think crypto market will reach a market size of around 4.5 trillion before we get to the top, which will, be 50% higher than what we saw in 21. If we start to see a deterioration, we start to see that also crumble. We will see a lot of startups that never ever got to earn money, or where the business case is rather questionable, will be closed down as well. And I think there is going to be a lot of havoc around in different parts of the economy. So because we have been living in a world of easy money ever since 2008, and you cannot print wealth, and when you try to do it, you will have a grand time for a certain amount of years. This time has been around 15 years. It has been tried before, but eventually we will see the outcome of printing money, which will be the downside of it, which will be the collapse of the values that we thought we had.
Yeah, and I think what happens is when people start to try and cash in, they need the cash. They go to these, trying to sell these assets, and they can't. We've seen that with commercial real estate. There's massive reductions in value, and I think that's what when you're forced to do these things, that's the worst time to have to sell, and it's the when there's the worst value. So yeah, but then I guess if rates come down and if things get better afterwards, and they could benefit, and sort of things will go back to easy money, or do you think this time will be the aftermath will be different?
I think the aftermath will be different because what we have is that we have tried now with easy money for some time, and what we've seen is that we've seen these the valuation levels just moving up higher. We didn't really see the trickle down effect that everybody was talking about. What I think that they will experience this time around is that the real economy will turn slower when they start to throw money at it again. And that means that we probably could see in a situation where inflation could be moving up, because there will be more money in the system actually chasing fewer goods. And that means that I think we could see a secular bottom in inflation this time around. I think it is going to drop to new lows before we actually get there. But when we get there, I think we could see a completely different kind of situation, and that's why I'm predicting a stagflationary phase also coming after the deflationary phase.
Okay, so if we look at sort of once you think we're at the top, are you just going to exit all assets, or what positions are you going to be looking to potentially put on?
Well, for now, as I said, it's crypto, it's small caps, it's Bitcoin miners. What I'll be looking at when the deflationary bust hits, it will be to get into dollars. It will be to potentially also short some Bitcoin. But then I'll be looking into the moment when we start to see the Fed coming back in again. Well, we've seen that before also, and that was in 2008, and we saw there where how the gold and silver actually took off at that point. So I think I'll be in gold and silver at the moment when we see that kind of development, and especially if it develops into a stagflationary scenario. Well, then gold and silver will be fantastic. Gold and silver meaning actually gold and silver miners, which is the big play that I see for the next year and a half, 2 years, and after that. So I think it'll be an extended crisis as well. It will be something which has two halves. First a deflationary part, then some kind of break, and then we'll see a secondary, which will be a stagflation. So, and it can extend into 26 easily. So it's not going to be a good time that we look into after these next 3 to 4 months.
Okay, and with that stagflation, I'm assuming that would be bad for a lot of these growth stocks and probably a bit better for the value stocks. Is that sort of what you're thinking, or it depends?
Yeah, well, everything is relative here, but I would not be holding any equities when you get a stagflation, because we have to remember that the demand is still not good, and so I think there will be new lows coming during the stagflationary phase. But relatively, yes, it will be better than our growth stocks. Growth and cryptos and the like will be absolutely, decimated in terms of value at that point. So that will be very tough for anybody in those assets. So it's about getting into where the real value is when you have a low growth scenario and you still have high inflation and or higher inflation at that point. Remember, I'm still predicting that inflation, or we're going to see outright deflation. So higher inflation at those levels. at that point and that will be that will be commodities, that will be gold, silver, copper, and the likes, and that will be the game the play that I see coming after that.
Okay, makes sense. So, Henrik, thanks again for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Well, I think it's to be careful this year. I mean, even though we will see a very strong bull market into the next coming months here, I think it's about understanding that things are not as great as the stock market may seem to suggest, and it's about understanding when to get out. So if you get into something of risk assets the next coming month, and I think there is a great opportunity because it's going to be such a strong move. Well, be very careful and know when to get out.
I think it's a great message. So thanks again for coming on. I appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Well, we got the Zeberg Report where I talk about the economy, macro outlook, the markets, and so on every week. So that's where I can be found. Well, it's a subscription service, and all these things that I've been talking about here is going to be laid out in charts and discussed more in thorough details on Sundays every week. So that's where to find me.
Perfect. I'll put it on the description below, but thanks again for your time today.
Thank you very much, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.